We might make a start, everyone. Thanks very much for coming along. We have one of these sessions today, so Chris has had a chance to kind of run through this. It's a bit of a smaller group tonight, but it'll give us a chance, hopefully, to have a bit more of a Q&A. So if you feel like asking any questions throughout, please do. We'll stop and have questions and a general discussion throughout. My name is Joseph. I'm a member of the Private Wealth team and the Investment Committee. My role here is to support the advisors and Chris in the investment matters for the firm. Chris has been with us, for those who haven't been here before and haven't heard Chris speak. Chris has been with Morrows since 2000 and CIO since 2007. So specialist knowledge in investment markets, portfolio construction, and a fairly extensive history as an advisor and superannuation. He drives our view on investment markets and portfolio construction. Knows our strategies inside out. So tonight he's going to talk about the investment markets and some of the implications for portfolios and the strategies that we use to deal with that. Housekeeping, phones on time. If you could, we are recording tonight and we will send a presentation out afterwards, so you can re-watch this afterwards if there's any questions. If you've not been here before, toilets out the main door and to the right down the corridor. That's really it for housekeeping, so I'll pass over to Chris and we'll get started. Just one more. There's plenty of food and wine, so please feel free to help yourself throughout the presentation.
Thanks, Joe. The title of tonight's briefing is Running with the Bulls. Does this bull market continue, or are we heading for a running with the bears? Some people have mentioned that that's quite timely given what's happened with markets so far in October. But we'll give an overview of where we are in the cycle, because that will be important as to which of those themes runs. The key themes driving the markets, we're going to run through those fairly quickly, just to give you a background as to where we think things are, but feel free to stop me if there's anything specific you want to run through. Then we'll spend more time on valuations and what that's going to mean for future returns, implications for portfolios, and most importantly, what opportunities have we got in the current environment to still be able to make money. Where are we in the cycle? In our view, we're in the late upswing phase. The key question to late upswing phase is we don't know how long that can last for. It can last for 3 months, it can last for 3 years, but it's typically comprised of rising inflation, monetary policy starts to tighten, bond yields rise, stock markets start to top out. That's definitely where we are, but we just don't know how long it lasts for. We're about to head into the longest economic expansion cycle in history. Prior to that, it was the 1990s, which lasted for 120 months or 10 years. As it stands today, we're at 112 months, and by July 2019, this current expansion cycle will be the longest in history. That said, it's also been the slowest recovery in history in terms of how gradual or how slow the US Fed, as measured by this bottom line, the dotted line, has been in raising interest rates throughout this recovery phase. In all other recoveries, the Fed has raised rates much more aggressively in terms of magnitude and much quicker than what the Fed has this cycle, which tells you that they've been a bit cautious on how fragile this current recovery is. We've also recently surpassed the longest bull market on record, taking out the 1990s tech boom. We're not quite there in terms of return size yet, but definitely in duration, it's been the longest bull market. So we'll touch on a few reasons as to why that's been. US confidence is at record highs. We've got consumer confidence, business confidence, and more importantly, because that's where all the jobs growth is, small business confidence is at the highest level since their survey started back in 1974. So you've got significant optimism out of the US. And what we're seeing as a result of that is a significant desynchronization between the US and the rest of the world. We're seeing it through monetary policy, where we've still got Japan with negative interest rates. We've got Europe with 0 interest rates. The ECB started to raise rates, but I think with Brexit, should that proceed, that's likely to roll over again. But here you've got the US Fed raising rates out of sync with all the other major central banks. The other thing that we're noticing with the US is typically when you go into a recession, they run large budget deficits. So the government spends its way out of that recession. But what we're seeing here is the US is pretty much at record low unemployment levels, but the government's spending up under Trump's administration. So they run very high correlations historically, and that's starting to break. So just an anomaly to watch. Then we talk, well, is the business cycle peaked? We've got US manufacturing, this blue line, at pretty much all-time highs in terms of how good manufacturing is going to get. We've got the other developed markets, the blue line, emerging markets starting to roll over, suggesting that the business cycle globally has or is in the process of peaking. We've also got global money supply, this purple line, starting to really fall. So liquidity is being drained, and that would typically be the top of a business cycle. That doesn't mean the top of a market. It just means that the business cycle may have run its course. The positive inflation is still contained for now. Why is inflation important? It's going up, but higher inflation means higher interest rates. And why don't we want higher interest rates? Because it means that equity markets need to revalue. It means that bond markets need to revalue. Do we talk about the new bear market in equities? Do we have a liquidity crisis? Do we have a recession, et cetera, et cetera? So higher inflation leading to higher interest rates is a big deal, but so far inflation's been contained. But we're seeing wage growth start to rise, and that's globally. The UK on the left, US, Euro, Japan, wages growth is rising globally, and that will at some point feed through to inflation. So it's something to watch. And if we start to see that data feed into inflation, the market's going to get really concerned that the US Federal Reserve has run behind the curve and needs to raise interest rates more aggressively than what they've been doing. And again, that's not going to be good for any markets. In terms of where we are in the cycle, the US yield curve paints a pretty good picture of that historically. So this blue line shows the spread or the difference in interest rates between long-term interest rates, US 10-year yields, and shorter-term US 2-year yields. We're currently starting to see that spread head towards zero, which means that you're getting paid more in short interest rates than you are in long interest rates, which is a good predecessor for a recession. And we can see that any time that blue line went below zero, the grey bars are recessions, a recession followed. So we're at 0.2 at the moment. It hasn't gone negative, but it's a good signal that a recession is closer than further away in the US. The good news is that on average, from the time that curve inverts or goes through zero, it's 14 months to the recession. And on average, it's 8 months before the markets actually peak. So we've got time. It's just something that the markets are watching that's been a very good signal historically as to where we are in this cycle. This chart shows Bloomberg data as to the recession probability in the US. And what this chart is showing is that recession probability is suggesting somewhere late 2019 to mid-2020 the US will be in a recession. We've seen the blue line here, which is the probability of a recession 2 odd years out, is starting to reduce. The white line starting to increase, which is the probability of a recession in the next 12 months. So what we're saying is, where are we in the cycle? A recession is somewhere in the near term, whether that be in the next 12 months, the next 2 years, the next 3 years. It's closer than further away. That has implications because recessions are typically associated with large market falls. And that's why it's such an important question, where are we in the cycle? So now we'll touch on a couple of key thematics that are playing out in the markets. Since the 1980s, interest rates have pretty much done one thing, and that is fallen. So most if not all of us in the room will have seen, 18, 20% interest rates back in those early days. We've seen those interest rates fall, but we've now broken the trend channel and interest rates are back on the rise. And why is that important? Because the US interest rates will determine interest rates globally. So as the US Fed starts to raise interest rates, our banks start to raise interest rates, regardless of what the Reserve Bank of Australia does. So it tightens monetary policy globally. And it's just a matter of how far they raise. And typically most recessions are caused by interest rates rising. So it's something to watch, but we've had this regime shift. On top of that, since the 2009 global financial crisis, we've had a whole lot of money printing and stimulus by central banks. That's starting to unwind. It peaked out in 2017. By the middle of 2019, those asset purchases or money printing goes net negative, meaning they're taking liquidity out of the system. Markets like liquidity. So we're yet to see what happens there, but effectively we've got rising interest rates and reducing liquidity. On a positive, corporate earnings have been really strong. We've had pretty much an earnings recession from 2012 through 2016. Earnings is the light grey bar. There hasn't been any corporate earnings growth. It's all just been markets rising or PE expansion. So markets just becoming more and more expensive. Throughout 2017, 2018, we've seen profit growth, which is really good for markets. We've also seen profit as a function of GDP almost go back to record highs. So companies are making a lot of money. Again, good for the businesses. So earnings and profits are really strong. Part of the reason for that is that those corporates are buying back their own shares. So the green bars there are companies buying back their own shares over time. 2018 is only an estimate. Some are predicting that'll be $1 trillion by the end of 2018. So you think if a company buys back its own stock, they're backstopping the market because they are the buyer of last resort. When a company goes in and buys back its own shares, it's like its own quantitative easing program where they're printing their own money, buying back the stock, and it props up the stock market because there's always a buyer there. So that's been a real tailwind for markets. On the other side of that, this current bull market's been quite shallow. And what we refer to in shallow is it's been driven by only a handful of companies. It's not broad-based, the markets have run hard. So when we look at this chart here on the right, what it's showing is the top 20 stocks have generated more than 60% of the market returns. So you've got a whole index or market of 500 companies and the top 20 have generated 65% of that return. The top 5 have delivered more than 30% of the whole market return. You've got to go back to the tech boom back in the late 90s to see anything like that type of shallow market. So it's these big tech companies that are driving markets as opposed to it being broad-based. And that has a bit of, or gives us reason to be cautious. If it's broad-based market rally, then it's deep and we can get a bit more comfort that it's real buying. Then we look at value and growth dispersion. So you think of the growth stocks as the tech stocks, the healthcare stocks, those companies with high growth potential versus a value type of company such as a bank, a utility, a telco, and the like. Good dividend paying, but not highly priced. And we've got that growth outperforming value sitting at levels we haven't seen since the tech market boom in 1999. So if you haven't been invested in growth, you haven't made a lot of money. But we're currently sitting at more than 2 standard deviations above the long-term average of outperformance. All that means is that at some point, this chart will mean revert, value will outperform growth. We don't know when, but basically, because we're saying the market rally has been so shallow, if you weren't invested in those big tech companies, you haven't made a whole lot of money. At some point, that's going to mean revert, though. It did back in the 90s, and it does it very quickly. We just don't know the timing, but that rubber band is really becoming stretched. Then we look at some sentiment indicators. What's the so-called smart money, the institutional money doing, and what kind of ratios are we running for bull and bear sentiment? And what we've seen is that the US market peaked in January of 2018 at roughly 26,700 on the Dow, then fell away. This is the smart money index, the blue line. That has gradually fallen away, meaning the smart money has exited the market. Even when the Dow Jones and US broader markets retested those highs and went through those highs only late September, early October, that smart money still hadn't come back in. So there's a lot of institutional money that's actually saying, you know what, we're pretty nervous. And he's currently in the sidelines, even though the US markets are near highs. When we look at bull and bear sentiment, back in January, the bull to bear ratio, so the number of people that were bullish and thinking this market was going to keep going compared to bearish, reached or surpassed levels we hadn't seen since the 1987 crash. So you're talking 30 years, the markets hadn't been this optimistic, and then whack, January. Now they're still quite high, which is positive for markets. There's still a lot of bullish sentiment there. The bears are quite low, the bulls are quite high, so that's supportive of markets. We've got the US midterm elections coming up on the 6th of November. That will be what's causing part of the jitters with the volatility we're seeing now, because what we're likely to see is the Republicans will lose control of the House, and this is the betting markets. Democrats take control, but the Republicans will retain control of the Senate. So you effectively got gridlock in Washington, which means that Trump's pro-business policies and pro-growth policies are going to come under a lot more scrutiny in terms of, are they going to get passed? Now, it's not saying negatively by the markets, it's just creating a lot of volatility up until we see the outcome of this. Now, if we looked at those kind of polling votes before the Trump and Clinton election, Trump wasn't anywhere near winning, and he did. So these things can backflip, and that's where there's a bit of volatility. But at this stage, the betting markets are saying that it's effectively a divided government. Trade wars in China slow down. Who's winning the trade wars? Definitely the US. Since Trump announced tariffs on China, the Chinese share market's fallen 26%. Outside of the last couple of weeks, the US share market was at a record high. That kind of tells you where the markets view this. We've also got Chinese GDP, investment, retail sales and production all falling. So China's slowing down and the markets are starting to get nervous. China will have a policy response without a doubt. That will probably give a short-term boost to markets, short-term boost to the Aussie dollar, the Aussie share market, etc. But whether it can be sustained is questionable. China's clearly slowing down and trade wars don't help them. But again, that's another point of contention as to why markets are volatile as we speak. So what keeps the bulls going? It's pretty much everything we've just said. Lots of liquidity, low interest rates, strong economic growth business investment, moderate inflation, strong corporate profit margins. Companies continue to buy back their shares and backstop the market. Low credit default swaps, so no credit issues. A positively sloped yield curve, so that yield curve doesn't invert and go negative, bringing forward the probability of a recession. Yes, it flattens, but it doesn't go negative. High consumer business confidence continues. Wages growth continues to rise. Retail spending, manufacturing remains strong. That's pretty much what we've got now. So should that status quo continue, then this bull market can continue to run well into next year. What awakens the bear? Pretty much if those growth drivers fail. Now, they don't all have to fail. Not one will have to fail. It's just a matter of market sentiment starting to turn it over. So there's lots of things to worry about: trade wars, Brexit, US Fed raising rates too quickly, Italian debt, geopolitical risk, asset bubbles bursting. They're there, they've been there for a long time. They won't go away. What worries us more about a bear market coming into play, and it's on the right-hand side, major bubbles that have burst, it's the magnitude and how quickly a bear market takes hold. So we can go back to 1900, and each of the major market bubbles that have effectively burst, they fell on average 40% in the first 2.5 months. That's why bear markets aren't good. You don't get time to react, it happens, and you get caught blindsided. Back in February, or late Jan, Feb of this year, US market fell 12% in 8 days. It caught a bounce, so a bear market didn't happen there. So far in October, it's down 8% in 1 month. So you can kind of see where these things extrapolate to should they take hold. So what we're saying is you've got to have protection in place against this bear market. So that's really where we are in the cycle. Recession, 12 months, 24 months away. Markets can continue to run provided the economic data stays up. This feels a bit more like a correction in what's still a bull market as opposed to the start of a new bear market. But nobody knows until a bottom's found. So let's spend a bit more time on valuations and what that's going to mean for returns. We're clearly late cycle, and that means that future returns are going to be harder to come by than what we've seen in the more recent past. This table by Robeco, they put it out every year, and they forecast 5 years out for major asset class returns. This was as recent as this month in October. The thing with this table is the best performing asset class that Robeco can find for the next 5 years is returning 4.5% in emerging markets. If your best performing asset class is returning 4.5%, what's your portfolio doing? Really low single digits. So let's explore a bit more as to why Robeco and others, that's just not their analysis and we share their view, why that's going to come about. US share market valuations are really expensive. The US market's the second most expensive in history behind the tech boom on most metrics. And based on that, we can see that Schiller metric, which is the blue line there, is suggesting that for the next 10 years, 8 to 10 years, the return from US shares will be negative 2.4% per annum for 10 years. You've got to think about that. Negative 2.4% per annum for 10 years. Why is that important? Back here at the top of the tech boom, that Schiller ratio was predicting negative 5% per annum for 10 years through the 2000s. The actual result was negative 3.8. It's not the number that's important, it's the fact that returns are going to be lower because valuations are so high today. Then we look at Australia. Shares aren't cheap here either. They're not as expensive as in the US, but they're not cheap. So again, buying Australian assets means that returns are going to be lower. In Australia, one of the things that we're looking at is what's the valuation of shares or pockets of shares. So we kind of showed in the previous chart that Aussie share markets are not cheap. But if we look at industrials, excluding the banks, that PE is 20 times. On average, it's in the 15s. So any type of growth stock, excluding the banks, is super expensive. And we can actually see that when we look on the table here on the left-hand side. This is calendar year returns for 30 September. What's done the best? Healthcare 29, IT 22, media 16, energy 13, growth stocks. What's lagged? Packaging, neg 12, banks neg 9, telcos neg 8, utilities neg 6. They're the value stocks. So the growth sector of the market is really, really expensive in Australia. But because banks are pretty much 40% of our total market exposure, the overall market doesn't look that expensive. But it's careful what you're actually buying. So I guess to put that in perspective, high valuations mean future returns are going to be lower. The chart on the left here shows interest rates gradually falling for 30 odd years. Now, if you want to invest in cash and bonds and government bonds and fixed interest, term deposits, doesn't matter what type of fixed income it is, it's called a 1 to 3% return. Back here, you could invest in a guaranteed government bond and get 10 or 15%, hence why returns were higher. On the other side, we've just shown the charts that say shares, property, growth assets, they're all really expensive. The second most expensive in 137 years if we look at the US. So what that means is that if all asset classes are expensive, future returns are going to fall. That's a chart by A&P Capital, who are quite optimistic. They're suggesting that a growth portfolio is going to return 6-ish% for the next, 5 to 10 years. We think that's optimistic. So we've kind of run through the cycle, we've run through the market thematics, where valuations are at. So let's just have a chat about, well, what does that actually mean for portfolios? Before I move on to that, has anyone got any questions or want to discuss anything in more detail around what I've run through? Okay, I'll keep moving through. This is a chart by BCA Research, which is a major independent global research firm. They don't run any money, there's no vested interest. This is just research. And what they've said is that long-run returns from strategic asset allocation, so your typical balanced or growth portfolio, are going to be very poor going forward. From 1982 to 2017, 35 years, the average return from a typical 65% invested in shares, 35% invested in cash and bonds, has returned 9.9% per annum. BCA's projections from 2018 to 2028, the next 10 years, they're forecasting 3.3% per annum. You think about that. Who in the room is factoring in that they're going to return 3.3% per annum for the next 10 years? Now, in here, they've got US shares returning 2.6%. A couple of prior charts, we said Shiller's predicting negative 2.4. So that could be an optimistic outcome. A&P saying it's closer to 6. Regardless of the number, it's lower than what we're used to. But what we're saying is that's if you invest into already expensive share and property markets and hold interest rate securities, cash and term deposits at record low levels. That's all you can expect. But there's options that investors have that say you don't need to lock into that, but you've got to think outside the box. You've got to look at your risk and return trade-off. So in our view, investors have pretty much got two options. They can take on a whole lot more risk to generate the same returns they're used to, or they can accept a lower return for the same amount of risk that they're used to. And it's going to come down to what's more important. Is capital preservation more important to you? Or is making money more important to you? And the answer to that question will ultimately feed into whether you stay in what we refer to an already late cycle expensive market and hope it continues to go up to generate returns, or you put in place capital protection strategies that will protect against market falls, but as the market keeps rising, you're going to give away some upside. So it's about balancing that risk-reward trade-off. You can dial up the risk, you can dial down the risk. What we don't want is a binary outcome. We don't want an all or nothing. You don't want to be the mouse sitting there going, I want my cheese. If I get it, I make a lot of money, but if I don't, I'm wiped out. So it's a happy medium, but you've kind of got to look at, well, what risk do I want to take? What risk do I want to hedge away? So let's look at the choices that investors actually have in the current environment. We've listed 6 here. Investors you always have and expect the historic returns. Hopefully with the charts that I've put up and just where we are in the cycle, everyone's concluded that that's impossible. Your historic returns aren't going to be what they, going forward, won't be what they were. Investors you always have and accept lower returns. Well, that's okay, but who wants to accept that? In most instances, a 3.3% per annum return isn't enough to achieve your investment objectives. Reduce risk, prepare for a correction, accept still lower returns. We're partially in favour of that option. I'll come back to that. Go to cash at near zero, wait for a better environment. Well, we can lock in 1 to 3% guaranteed, but you might be locked in there for a long period of time because we don't know how long this late cycle lasts. Late cycles typically put on the best investment returns, so you might be sitting on the sidelines for a long period of time. Increase risk in pursuit of higher returns. Just go all in and say, I'm going to ride this market and extrapolate as much as I can out of it for as long as it rises. Watch out for that bear market when it happens though. Remember, average of 40% in the first 2.5 months. Make sure you're good enough to get out if you're going to take option 5. Option 6, put more into special niches, special investment managers that aren't linked to markets. We're big advocates of that in this current part of the cycle. So it's a combination of 3, take some risk off the table, put some protection in place for the inevitable correction, which is what we're seeing now, but in the end of the bear market, but allocate to strategies where you've been rewarded to take risk and aren't relying on the markets to do the heavy lifting. So we'll start to run through a few of these in detail. So please stop me where you want and ask some questions if there's anything that you want to delve further into. Cash and fixed interest. The RBA cash rate, so the Reserve Bank cash rate is currently 1.5%, the lowest on record. 10-year government bond yield is currently sitting at 2.6%. So you really, if you want to sit in Australian cash and Australian fixed interest, you are locking in a 1 to 3% return. That's the best you're going to do. Cash provides you with optionality. Other than preserving capital, it provides you with optionality to buy markets at a better time at a later point in time. But other than that, that's about all we see cash is good for at the moment. US fixed interest is a lot more interesting in that because US interest rates are rising, their cash rates are rising, so it's becoming a much better asset class to hold. You can now earn a 3.2% yield in the risk-free asset, the most risk-free asset of anywhere in the world, called the US Treasuries. They'll never default on it. So 3.2% in that environment looks pretty good. But the problem is, if interest rates spike up to 4%, you're going to carry a paper capital loss because holding those longer dated US Treasuries or US government bonds as interest rates rise means you lose money. Hence, we haven't been anywhere near this market for years because it's been a rising interest rate environment. What the aim of this is to pretty much try and pick a peak where that US interest rate can't go up anymore without absolutely causing a recession. Where we see this is somewhere between 3 and 4% will be a great opportunity to invest into long-dated US government bonds. Because when the next US recession takes hold and they need to cut interest rates back towards zero, which they will need to do, because all of the evidence suggests that to avoid a really hard recession in the US, they need to cut rates by 5% during a recessionary period. Their current interest rate's 2.25. So hence the Fed will raise rates in December unless this current market volatility turns into something a bit more nasty. And the market's factoring in, or they're giving us forward guidance of another 3 to 4 rate hikes next year, which give or take takes them up to 3.5. Still well below the 5 that they need. But as that interest rate rises, there's going to be a really good opportunity to buy US government bonds because when they have to cut rates, these securities are going to give us really strong double-digit returns in what's effectively the most secure asset in the world, US 10-year Treasuries. The really hard part's the timing. Because we could recommend it to clients to say, well, you know what, 3.2, it looks okay, let's not hang out till 4. But the problem with that is if the interest rates go to 4 and we don't lock in but give you a paper loss of 15 on the defensive part of your portfolio, you're saying, well, that was never happened. That was never meant to happen. I'm not meant to lose money in this asset class. So the timing's the big issue, but I think there's going to be a really good opportunity to go long duration US bonds into the next US recession. So that's something we're watching. Credit markets, we still think it's a bit too early. Most businesses are starting to really lever back up, particularly in the US. So leverage has gone back above what it was in the 2007 peak. And what we're seeing is deteriorating quality. So the purple bar here is triple B rated, so lower quality companies. And then the blue lines are the higher quality double A's and A's. The triple Bs or the lower rated credit qualities are actually becoming more and more prevalent. So credit quality is deteriorating, leverage is rising, and spreads are still quite low. There'll be a much better time to enter credit markets, and that will be during a recession, but not quite for now. Aussie dollar, where do we see the Aussie dollar? Should we be hedged or should we be buying global assets that can benefit from a fall in Aussie dollar? As it stands today, we're trading just over 70 cents relative to the US. But what's interesting and something that we haven't seen since the Aussie dollar floated back in December of 1983 is that Aussie cash rates, the spread between Australian cash rate and US cash rates, is now the widest we've pretty much seen since the Aussie dollar floated. Very rarely, if not ever, does the US cash rate trade higher than the Aussie. We've always had higher interest rates until now. So as the Fed keeps raising rates and the RBA stays on hold, that spread only gets worse, which should put downward pressure on the Aussie dollar. So most of the consensus views are the Aussie dollar's got a 6 in front of it. That doesn't mean it's a 60 cent number, but it might be 67, 68, 69. So there's downward pressure on the Aussie dollar, which is favouring buying global assets. Developed equity markets, we can see here in this chart, US has clearly outperformed the rest of the markets. There's been a significant disconnect between US markets, and primarily because they've got a huge tech sector which has been driven by all of the growth. But at some point we're going to see mean reversion because the valuation difference is so large that at some point markets will rotate out of the US and go into these much cheaper markets. The call on that is when you see that growth dynamic start to change, and I think it's probably a bit too early to call that now, unless what we're seeing today is the start of a new bear market. Then growth has peaked. But really it's just a matter with the developed markets at what point that rotation happens, because there's a whole lot of money to be made in value as opposed to growth going forward. Emerging markets, a significant dispersion. Developed markets, the 30th of September, were up 5.4%. Emerging markets were down 7.7%. So 13% performance differential in those markets. The developed markets are so much more expensive than emerging markets. We can see Argentina is down 50% this year, Brazil down 12%, India down 10%, China down 10%, etc. Emerging markets have been hit hard because the US dollar is rising. Most emerging market debt is denominated in US dollars, so as the US dollar rises, that puts a lot of pressure on these economies. We think it's too early for emerging markets, but they are looking cheap. There'll be a much better time to buy. So that's the major asset classes, fixed income, shares. Then we get to what we refer to as our absolute return strategy. So this is where we actually can find value and can justify allocating capital. We've got equity type strategies, being long, short, equity market neutral, macro strategies, global macro managed futures, which more play on the bigger thematics of the market. Do we want to be long US dollars, short US dollars? You know, where's the broader market direction going? And then we've got private markets. So when we refer to private markets, we're moving away from the listed ASX or the listed S&P 500. These businesses that you can price daily, get driven by sentiment. We go to private markets where they're private businesses focused on long-term value add. So we see some good opportunities there. So I'll run through a bit more of these in detail. But what we're effectively trying to do here is get rid of the market risk, because we've already said that the US market's the second most expensive in history. Why do we want to take that on? Let's hedge that out and take on manager skill risk. Let's get people to generate returns for us going forward. So I'll run through this in a bit more detail as to some of the strategies that we employ here. A typical long-only strategy means you've bought the market long, you get all the upside, you get all the downside. You're just long the market. A 130-30 strategy, long-short, means you go long 130%. So effectively lever up the market to 130%, but you sit on the other side at 30% short. So you're 130 long, 30 short, meaning you've got 100% exposure to the market. Same as if you were just invested in the markets. Why do we favour this though? Because these managers or strategies, in that additional 30% that they're investing into the market, that's their highest conviction ideas that should outperform the market. So if this 130 portion is outperforming the 100 market, and on the short side they're picking businesses that are just low quality and won't go up by anywhere near the amount of the market, then that 130-30 strategy should always outperform the market. So if we're saying markets are expensive and we need to outperform them, long short is a way to get extra return. Then we can move across to just pure long short strategies. So you're 100% long, you're 20 to 80% short, your net exposure to the market is 80 to 20. So you're really just dialing up and down your risk to where you see value. So if the markets are cheap, you run it at 100% long. When the markets are expensive or risks are high, you put your shorts in place and you dial down that market risk to take some of the downside protection out. So you're running a much lower risk portfolio in that long short strategy. Then we go all the way to the right side there, which is your market neutral. 100% long and 100% short, meaning zero market exposure. No market exposure. You've got 100% of your portfolio that's long the market, wants it to rise, 100% that's short the market that will offset it. So that's a way for us to completely hedge out the market risk that we're really nervous about because valuations are expensive. I'll then explain, well, how do these strategies make money? But they're three strategies that we can be in rather than just being in the market. Why use short selling? Think of the ASX 300. So the 300 businesses in the Australian share market, they are not all good. There's a heap of bad ones in there. Structural overcapacity, demand destruction, their technology is becoming obsolete. They've got to delever, they've got a broken business model, they've got a broken brand, they're in a cyclical downturn, there's just no growth in the industry anymore. Then you get to the asymmetries, the things that really cause companies pain, balance sheet risk in terms of leverage, regulatory risk that's put on them, transactional risk that they buy the wrong business or they overpay for the wrong business. And then you've got the misperceptions, which is the bad accounting methodology, fraud, and just pure poor management. People that don't know how to run businesses. You don't want to hold them for one, but if you're long only, the best you can do is not hold them. If you're long short, you can short sell them and profit from these bad companies. Again, it opens up your opportunity set to make money. Let's not be stuck in this 3.3% per annum world because all markets are expensive. If we expand the opportunity set where we're able to make money through these, then we're not stuck in that world of 3.3% per annum. So let's look at an example of a stock that's short sold. Campbell's. So most of us in the room would know the brand Campbell's, a lot of canned food. They're in structural decline. Why? There's a lot of fresh, healthy food trends in place. Competition from private label, small brands is picking up. Then we go to the divergent expectations. The expectations for this company are quite optimistic, but when you go and do your due diligence on it, their organic sales are declining and cost pressures are rising. So there's significant pressure on this business. They're levered to 5 times, which is high relative to peers. And also within the misperceptions, they've made a lot of acquisitions that are masking the lack of organic sales growth. So the business is actually fading, but they're buying other businesses to mask what's actually a structural decline. And what we see is the short position was put on here. the strategies we use, they don't short every day. They don't buy, sell and try and profit 20 cents or anything. These are structural declines in businesses. So the short goes on. They would look pretty happy there. They've made over 20%. Then the stock rallies. And then the market starts to realise all of these imperfections within the business. That's called a 45% profit in a stock that fell. As part of your due diligence as a fund manager, or if you buy and sell shares, you should be looking at lots of businesses, peer business, and say, what are the good ones? And as a part of that analysis, you naturally find bad ones. By just avoiding those bad ones, you're leaving a lot of profit potential, short selling potential on the table. Because as a long short manager, you can take advantage. If you're long only, the best you can do is not be there. Long short variable beta strategies. These are strategies that basically just buy this dark black line. They move in and out of the market depending on where valuations are and where risk is. The number one aim is protect the capital. Market falls 50% here. This fund protects the capital. And over time delivers a much stronger return than the market. Why? Because it's active. It doesn't have to always be in the market. And it's using long, short strategies to dictate when it wants to be long that market and when it wants to be short that market. Another way to make money without having to rely on the market. Market neutral strategies, we've touched on that before. We've got what's called pairs trading. So pairs trading, so we looked at an outright short selling example. That was just a poor business that you can take advantage of. Another way to do investing is what we call market neutral via pairs trading. So you think of Wesfarmers and Woolworths, two very similar businesses. All as you want to do when you look at those two businesses, you don't want to own them both, because as soon as you own them both, you're long the market. You're in. Because if the market falls, they're both falling. What you want to do is say, which one's better than the other? Which one do I like better than the other? And as soon as I've come to that conclusion, I'm going to say Wesfarmers is a better business than Woolworths. I'm going to go long Wesfarmers, short Woolworths. Well, as long as Wesfarmers goes up by more than Woolworths does, the grey line's your profit, 24% from that trade. If you held both of those shares long, you made zero. But the ability to be able to pick one over the other and still hedge your portfolio out against the market risk enables you to make money regardless of what the market's doing. And that's why we favour market neutral. And we can see here BlueScope versus Amcor, Challenger ANZ, Qantas versus Flight Centre. You're not saying one of these companies is an absolute disaster. You're just saying that over a long period of time, one will do better than another, and I'm going to be long and short that. What we see with market neutral strategies, this is a blend of 5 managers that we use in the market neutral space, 20% in each of the 5 over the last 5 years to 30th of June. The blue bar shows the return of that market neutral strategy being 9. The lion's grey bar is the ASX 200, the market returning 10%. So pretty similar type of returns over 5 years. But the compelling reason why we like market neutral is the volatility or the risk of the ASX market being in the market was 11% versus 4.5%. So we're focused here on risk-adjusted returns. How much risk do we have to take to generate some return? And the reward or the return to the risk of market neutral is more than 2 times that of the market. Really strong risk-adjusted returns, and the downside protection was more than 3 times as good as the market. I'll take that any day over investing in an expensive market. It's just another way to generate returns without having to rely on markets at this late cycle phase. Trend following strategies typically deliver really well when the markets implode. TechRec markets fell 45, trend followers did 65 plus. 2008, the market, US market fell 37, trend following did 25 plus. So they provide a lot of protection or cushioning when the markets fall. And that's why we have this strategy in the portfolio. It's protection for that bear market when it happens. This blue line here That's a fund that we use, Aspect, since its inception in 98. It has outperformed bonds, it's outperformed cash, it's outperformed shares over that long period of time. Why? Because it avoided the big drawdowns. It actually made money when everything else was losing. So that's another way. Private markets is an area we really like at the moment. Why? If you're invested in the public markets, and when I refer to public, the listed markets, Commonwealth Bank, BHP, Telstra, the listed markets, you can trade those stocks every day. The information that's out there in that market is publicly available. You have very little informational advantage compared to anyone else in buying BHP, because all of the markets, all of the data is public. You go to private markets and you effectively become what we refer to as a corporate insider. When you go into those businesses, you know everything about them. And if you knew as much about these in the listed world, you'd be considered an insider trader and you'd be sent to jail. But over here, you've got the public markets. You're incentivized by very short-term profit incentives. There's no incentive to try and grow the business over a 5 or 10 year period, because your bonuses and your profit share and your options all happen on a quarter-by-quarter basis. Over here, you're incentivized to grow long-term value in businesses. So the growth opportunities over here are much larger. And there is an illiquidity premium. By locking your money away for a period of time, you can make better returns. This is the listed markets. Global share markets, this is the private equity index, and this is Partners Group, which is a manager that we use for client portfolios, doing deal by deal, selectively adding value. You get paid more in return if you're prepared to give up some liquidity, and we're seeing opportunities there. And we bring that back to your long-term return objectives. You've got to have some short-term liquidity for day-to-day things. You've got to have a medium-term investment portfolio to deliver your core outcomes. But you've got to also look to or be comfortable to allocate to long-term illiquid strategies over a 5 to 7 year period where you can't access your money, you can't redeem it. But they're those returns that can deliver long-term growth potential outside of what the markets are going to do. So it's a matter of how comfortable you are, and there's no right or wrong. Is 10% the right exposure to that? Is 20%? Is 50%? There is no right and wrong. It depends on the risk tolerance you've got, the time frame you've got, but you've got to have something in there. Because going forward with listed markets so expensive, that's where you can still generate returns to get you above that 3.3% that you're going to get if you just stay status quo in the already expensive markets. So we'll summarise here and say the cycle, where we are in the cycle, and valuations absolutely matter. And I'll pose a question. In which decade would you prefer to own equities or shares? Decade 1, unemployment was low, 4.7. Real GDP growth was strong at 4.2. Earnings growth was 2.6, fantastic. The economy is going really well. Decade 2, unemployment high at 7.2. GDP is much lower at 3.5. Earnings growth from businesses is negative. Really great economy, really poor economy. Which one do you want to own equities in? Well, decade 1, for the next 10 years, you earn 3% per annum. For 10 years. Decade 2, you earn 11.7% per annum. That's the great economic environment. The issue with decade 1 was your starting valuation was 17.8 times. Decade 2, it was 8.5. I start out buying really expensive assets, and today that's 20. And all of the figures on the economy in the US are showing really strong. Low unemployment, strong GDP growth, strong corporate earnings, excessive valuation. Decade 2, where you've got negative earnings growth, high unemployment, the economic environment's not good, but as a result, the markets are cheap. I can buy it at 8.5 times. So buying high assets will never give you good long-term results. Buying cheaper markets will give you good long-term results. So the cycle and where we are, and valuations will have a meaningful impact on your longer term returns. We can't tell what they do over 1 or 2 years, but meaningfully over 5 to 10, absolutely. So what are the key takeouts? Returns are almost certainly going to be lower, particularly if you're holding a passive portfolio of low income earning cash and fixed interests and expensive shares and property. That's not going to bode well for long-term returns. To outperform going forward, you're going to have to protect against the eventual bear market. Now, we don't know when that is, but it typically will be associated with a US recession. And if a US recession is sometime in the next 12 months, 2 years, 3 years, then it's sooner rather than further away. A better buying opportunity is absolutely going to present itself. It's a matter of how patient you can be and whether you can overcome the fear of missing out, meaning I've got to be investing in this market, everyone's making money, I can't afford to be on the sidelines, or protecting capital. No one rings a bell at the market top. So you've got to look at, well, which risks do I want to take? Do I want to be in the market and just ride it? You know, as option 5 and option 1, effectively, the 6 investment choices we've got. Or do I want to actually have capital protection in place, hedge out some of that risk and take on some alternative risk, some illiquidity risk? Because ultimately, when we look at the current market, the bull market can absolutely keep running into next year. But what we're saying is make sure you've got some protection in place to hedge against that eventual bear market. Because as we said, the first 40% on average decline happens in the first 2.5 months. So if you don't have any protection in place at the start of it, good luck trying to put it in place whilst it's happening. It's a real challenge. So I'm going to leave it there. I'm going to open up to questions and just general discussion. So if there's any slides you want me to retouch on or